It is the end of an era here. All remaining Sears Canada stores closed yesterday, marking the end of an era for that retailer in this country. South of the border, Sears has just raised $100 million in financing to help keep it afloat. Hayley Woodin from Business in Vancouver joins us by Skype with more on that. What are the chances that Sears can survive in the U.S.?
The chances are looking pretty slim, but this new round of financing is going to go toward trying to keep Sears in the U.S. afloat. Sears south of the border has faced 6 consecutive years of losses. If we look at the fiscal year for Sears in 2017, it looks like it's also going to run a loss, so that would bring it up to 7 years of losses, which is never a good sign. And the company has recently said, too, that looking at the past holiday quarter, comparable sales down anywhere from 16 to 17% year over year, which, again, never a good sign. This tends to be the quarter in retail. So if you're struggling throughout the holiday shopping season, likely a sign that you're struggling all year round. Sears, south of the border, though, still around. We'll see how long that lasts, but Sears overall is an example of a company that jumped on the e-commerce train too late, didn't make the tough decisions it maybe needed to earlier on in the game. We've seen retailers like Hudson's Bay Company, for example, try and reinvent itself recently. It has jumped into e-commerce. It has sold some of its really high-profile prime real estate locations too. Wasn't the case for Sears. So we might see Sears south of the border for the time being, but it looks like it's going to have some major struggles ahead of it, and $100 million in financing, likely not enough to solve some of those big issues.
And we'll have some major ramifications for the shopping centers that use Sears as an anchor store. So that yet to be seen. Hayley, lots of people wanting to invest in cannabis these days for good reason with the changing laws coming to this country. You have some news on this front?
We do. Horizons ETFs, which launched the first ETF in North America to follow some medical marijuana companies, is proposing to launch a new fund. It would be the Junior Marijuana Growers Fund. But a couple of important things for retail investors to know. This is going to be a very high-risk fund as determined by Horizons itself. It's going to follow junior growers in the space, so not the big-name companies we've heard about over the last year like Canopy Growth or Aurora. We're likely never going to have heard from them before. They're juniors. So if you think about it like the mining industry, it's not the big name mining companies, it's the more risky junior companies that will be in this fund. The interesting thing, though, too, here is that the original fund from Horizons didn't touch any companies tied to the marijuana market in the U.S., of course, because marijuana remains illegal south of the border. But this new fund very well might. It's going to include growers involved in the medical or even recreational marijuana space in the U.S., which poses a bunch of legal hurdles. Of course, anything that happens in the U.S. could put those companies at risk. And we had some important policy changes recently where the U.S. federal government has determined that it can now perhaps intervene in states where marijuana is legal. So it's going to be a volatile
situation
fund.
we are going to have to keep in mind, and we will be watching that very closely. Thank you so much, Hayley Woodin from Business in Vancouver.